I think you can do very well as a stock market investor if you find really high quality companies and you buy them at attractive prices. And I think today, is a pretty good time. It's a pretty good point of entry.
Now, it's no secret that this year has been rough for investors in the stock market. Stocks entered a so-called bear market this year as prices fell more than 20% from their highs. The S&P 500 was down as much as 25%, the Dow Jones was down as much as 20%, and the tech-heavy NASDAQ has been hit the hardest of them all, down 35% from its high. Now, that sounds like pretty scary stuff for stock market investors, right? What if I told you that now is actually a great buying opportunity? This isn't coming from me. This is coming from billionaire investor Bill Ackman. In this video, we're going to examine why Ackman thinks now is a great time to be buying stocks. We also are going to reveal Ackman's 4-step checklist to picking great stocks to invest in. But first, make sure to like this video and subscribe to the channel if you aren't already, because it's my goal to make you a better investor by studying the world's greatest investors. Let's get into the video.
Look, it's much easier to make money in the stock market in a rising stock market environment. And if rates, a declining interest rate environment is generally a market in which asset prices increase. And so a rising tide lifts all boats. So if you just own equities, I think, right now we're in a rising interest rate environment. So that's obviously more challenging. And really, I think that what matters is, are the central banks around the world going to stop this out of control inflation? I would say, I think they will. And what's the new level of long-term inflation? Is it going to be, are we in a world where it's difficult to create, where the federal, as recently as, 24 months ago, central banks around the world were worried about deflation. And that's been a very, very dramatic change. And so I think you can do very well as a stock market investor if you find really high quality companies and you buy them at attractive prices. And I think today, is a pretty good time. It's a pretty good point of entry, right? March of 20 was obviously a very, very good entry point. And anyone who bought stocks in March of 2020, something I went on TV and advocated on March 18th of 2020. I said, this is a moment. I think this is sort of another moment where I don't know how well you're going to do over the next 3 or 6 months, 12 months. It's a highly uncertain world. But over the next 3, 4, 5, 10 years, it's a pretty good place to be an investor, or time to commit more capital to equity markets. Although you got to pick carefully. You want to own the super high quality, well capitalized, dominant businesses that will be here, 30 years from now. And that's why we own companies like Hilton and Universal Music and restaurant brands and so on.
So what you're saying, whether or not there's a Q4 correction or whatever, that doesn't really matter. If you're looking further out, a few years, 3, 4, 5 years out, now's a good time. You'll look back on today and think, yeah, that was a good time to buy.
For sure. That doesn't mean the market's not going lower in the next 3 months, right? But I wouldn't commit all of your capital today, right? Keep some in reserve. A bit of as they used to call it, dollar cost averaging. It's S&P's down, approaching 20% for the year, and it wasn't highly overvalued at the beginning of the year. So I think prices are fair to cheap.
As Bill Ackman mentioned in the clip, the stock market has been clobbered this year due to high inflation and the higher interest rates that come along with it. Inflation is running at its highest rate in generations, and this is scaring the US Federal Reserve. In an attempt to get inflation under control, the Fed is raising interest rates dramatically, and this is negatively impacting stock prices. The hope is that increasing interest rates will help slow down the economy and cool inflation. In investing, the most commonly used metric to measure interest rates in the economy is the yield on the 10-year US Treasury bond. Yield is just a fancy way of saying interest rate. This would be the return you could expect to receive for lending the US government money for 10 years. The yield on the 10-year Treasury was just 0.5% in the summer of 2020 and has since risen all the way to 4%. This is a nearly 8 times increase in just 2 years. Now, investing during normal times is hard enough, but add on rising interest rates and that makes things even more difficult. That brings us to the sponsor of today's video, Candlestick AI. Candlestick is an investing app that uses cutting-edge AI technology technology to offer you stock picks, ratings, and insights for just $9.99 a month. You can customize your model to fit your investing preferences. If you're looking for maximum opportunity, the broad market model offers top-of-the-line picks from the entire US stock market. If you're looking to play it a bit safer, the blue chip model picks from the S&P 500 market index, which includes many of the world's biggest companies. Candlestick's picks outperformed the market 9 out of the 12 months in 2021, and they're outperforming again in 2022. Insights from your model, performance updates, and news stories about your picks are just a tap away inside the app, so you'll never feel like you're investing blindly. Start your free trial now and get ready to invest smarter with AI. Now let's get back to the video. In the words of Warren Buffett, interest rates are like gravity on stocks. The higher interest rates go, the more downward pressure there is on stock prices. Let me explain what he means. A stock is valued based on the cash it will generate discounted back to the present day using a given interest rate. This so-called intrinsic value is how much the stock is worth. Now, I know that definition sounds intimidating, but the math is actually pretty simple. Let's see how rising interest rates impact the intrinsic value of stocks. Let's say we have a stock that will generate $20 in cash for us in year 1. In this example, the stock will be able to grow the cash it generates by $20 a year for 10 years. So $40 in year 2, $60 in year 3, all the way to $200 in year 10. For simplicity purposes, we're going to say the company stops operating in year 10, so you won't receive any cash from selling the stock. Now, in order to determine a value for this stock, we have to discount it back using an interest rate. Let's start out with a 5% interest rate. This gives us a stock price of $787. Now, let's see what happens as interest rates start to climb. If we take the interest rate we used as 7%, this causes the value of the stock price to fall to $695. Notice how the stock is worth less than before, despite producing the same amount of cash. The only thing that changed was the interest rate. If we take the interest rate all the way up to 10%, we see that our stock price falls even farther, all the way to $581. Just raising the interest rate from 5% up to 10% caused the value of our stock in this example to fall by 26%. But given that interest rates are rising, why does Bill Ackman think now is a great buying opportunity? It has to do with the fact that he believes the Federal Reserve will be able to get inflation under control. Once inflation is brought back under control, the Fed can stop aggressively raising interest rates. In fact, the Fed might actually start lowering interest rates once inflation starts to normalize and the economy weakens. So if we go back to our earlier example, let's see what happens as interest rates decrease. We saw that a 10% interest rate resulted in a stock price of $581. Remember, rising interest rates are like gravity on stock prices, pulling stock prices down as interest rates increase. But on the other hand, decreasing interest rates are like jet fuel, propelling stock prices higher. Let's see this play out in our example. Let's bring the interest rate down to 8%. This causes our stock price to rise to $654. Let's take the interest rate down even farther to 6%. This causes another bump to our stock price, setting the price up to $739. If we get really extreme and take the interest rate all the way down to 2%, the stock price skyrockets all the way to $959. In the clip, Bill Ackman was making the argument that people who buy stocks now are going to benefit from the tailwind of interest rates coming down as inflation starts to get under control. As we saw in our example, declining interest rates are a positive for all stocks. However, Ackman was quick to point out that investors shouldn't just buy any stock. You want to be selective in which stocks you buy. This is because movements in interest rates are notoriously difficult to predict. You want to buy the right stocks and let declining interest rates be an extra bonus on top. This naturally raises the question of what characteristics should we as investors be looking for in stocks. But thankfully for us, Ackman has provided a checklist of criteria that he uses at his multi-billion-dollar hedge fund, Pershing Square. Here are Ackman's 4 criteria for what makes a stock something that could be worth buying. The first criteria is that a business needs to be simple. Look at the stocks in Ackman's portfolio. We have home improvement retailer Lowe's, fast casual restaurant Chipotle, Restaurant Brands International, a holding company that owns brands like Burger King, Tim Hortons, Popeyes, and Firehouse Subs. We also have hotel chain Hilton and the railroad Canadian Pacific. While these businesses are in different industries, they all share the common trait of being relatively simple businesses. While Bill Ackman did go to Harvard, you don't have to have an Ivy League degree to figure out how these businesses work. If you're watching this video, I guarantee there's a good chance you're intelligent enough to understand how a business like Chipotle works. Compare that to other companies like biopharma stocks as an example. You almost have to have a PhD in chemistry to be able to even start to understand the businesses within that industry. The next criteria is that a company needs to be predictable. This means that you should be able to have a rough estimate of how much money the company will make in any given year. Think of predictability as a spectrum. On one end, you have highly predictable businesses, like those that own real estate, for example. You know every year that company's profit will grow a little bit as rents are raised. You could project out what that company will be making 5 years from now, and odds are you won't be too far off. On the other end, you have companies like electric vehicle startups. In 5 years, these companies could be making billions in sales, or they could be bankrupt and doing $0 in sales. So if you look at Ackman's portfolio, his stocks definitely fall towards the very predictable end of the spectrum. The third criteria is arguably the most important. The business must have what is referred to as a moat. Capitalism is brutally competitive. If a business is making a lot of money, someone else wants to come along and take the profit from that business. A moat is what stops competitors from destroying a company's profitability. Picture a castle. In our analogy here, this is a company's ability to generate a large profit. The larger the profit, the more rival companies are going to come after that castle. The moat around the castle in this picture is what keeps those competitors away and allows the company to remain highly profitable. Take the railroad industry, for example, and Ackman's holding Canadian Pacific. Canadian Pacific has a huge moat. The railroad tracks that the company uses to move goods took hundreds of years to build. As a result, if you are a company and want to move your products using rail throughout this part of North America, you don't have a ton of choices. You have to decide between Canadian Pacific or their rival Canadian National. If someone wanted to start another company to rival Canadian Pacific, it would cost tens of billions of dollars. And this is even assuming you could get permission from the government to build the thousands of miles of track necessary. This huge moat allows Canadian Pacific to be extremely profitable and prevents any competitor from entering the industry and encroaching on that profitability. Now onto criteria 4. If the stock has met the first 3 criteria, simple, predictable, and having a moat, it now has to meet one more, selling at a discount. As we talked about earlier, a stock is valued based on the cash flow it will generate. That is referred to as the stock's intrinsic value. Think of intrinsic value as what the stock is actually worth, which can occasionally be significantly different from what the stock is currently trading at. While going into the specifics on how to calculate intrinsic value is too much to cover in this particular video, here's how to think about it. Let's say that you determine that a stock's intrinsic value is $100. You don't necessarily want to buy this stock when it is trading at $100. Instead, you'd want to buy this stock when it is trading at, let's say, $70. That $30 difference between what the stock is currently trading at and its intrinsic value is what is referred to as your margin of safety. This margin of safety keeps you from losing money if your estimate of intrinsic value turns out to be incorrect. A margin of safety is especially important when you have a concentrated portfolio like Ackman. He only owns a handful of stocks in his portfolio. This means that even if he is wrong only about one of his stocks, the results can be disastrous. These 4 criteria have helped Ackman become one of the most respected investors in the world. Yet, they are simple enough that you can start applying them to your own investment strategy. You should be looking to invest in businesses that are 1, simple, 2, predictable, 3, have a moat, and 4, are currently trading for less than its intrinsic value. While these 4 things may sound very simplistic and basic, virtually nobody does them. As Charlie Munger likes to say,